Hello, everybody. We are tackling this week chapter 11, which should be an easier chapter, so this will be a quicker video. I say that, but then I'll ramble, I'm sure. Um, because the first half of it tackles notes payable, which is the opposite of notes receivable. So in class, we talked about notes receivable, I think in the allowance for doubtful account chapter, just briefly. Well, now we're going to talk about just what does it look like on the other end when you are the one borrowing the note. um, you have a note payable. So in this case, we are the borrower, not the lender. So think of an accounts payable. When you buy something but you don't pay them right away, you recognize an account payable. Liability, you got to pay them back. Note payable is the same thing. It's just a longer term borrow. So account payable, normally you don't have to pay interest because it's short term, somewhere 0 to 90 days, usually 0 to 60 days. And then a note payable is anything longer than that. Okay. So to start, we're going to look at two ways. If you guys remember from the notes receivable section, I feel like I'm losing my head here. From the notes receivable section, oftentimes notes receivable would be created by turning an accounts receivable to a note receivable. Same theory with note payable. Okay, we're going to turn an account payable into a note payable. So we're going to say we are given the opportunity to turn our $1,000 account payable that we owe another company into a 90-day 12% interest note. Okay. So the first thing we would do in a situation like this, if you remember back to notes receivable, we have to get the account payable off of our books. So we have to get rid of that, and then we have to recognize a note payable. So notes payable and accounts payable, they're both liabilities. Okay, debts we owe. So to get rid of the account payable that we owe, we're going to debit account payable. Okay, remember liabilities, if you're going to decrease them, you debit them. We're going to credit note payable, $1,000. So to recognize the note payable, whenever you increase a liability, you have to credit it. So this is how we just created our note payable. Okay? Now interest, when we're going to pay the note, say it's 90 days later, we pay the note off. So again, we're the ones paying. So when we were doing it the other way with notes receivable, we received interest. We were the company receiving interest. Now we're the ones paying interest. So journal entry is not going to look that much different than what we saw with notes receivable. We're going to debit. What do we have to get rid of? We have to get rid of the note payable. We got to get this off of our books. So we're going to debit note payable, $1,000. Okay. We know we have to credit cash because we're the ones paying the debt now. So we're giving out cash. So we're going to credit cash, but I'm going to leave the dollar amount blank. The last thing we have to account for is interest. Now, back with notes receivable, whenever we received interest, it was interest revenue. So revenue got credited. But since we're the ones paying the interest now, it's interest expense. And like all other expenses, when you recognize an expense, you debit it. So we're going to wind up debiting interest expense. The calculation is the same that it was for notes receivable. So whenever you want to calculate interest, it's the value, $1,000 in this case, times the interest rate, 12%, times the number of days out of the year. So remember, guys, back from when we talked about notes receivable, I said for accounting purposes, a normal business year is usually closer to 360 days rather than 365. So for all intents and purposes, for all of the assignments I give you, assume 360 days is a full year. Okay, and I'll know who watches this video and who doesn't, because if I get an email on the assignment asking what year are we using, I will say refer to this video. Anyways, So this is your formula, and we're going to see that the interest, first of all, put an equal sign if you're doing it in Excel. The interest will be $30. So we reduce the note. We got to get rid of the liability. We're recognizing $30 of interest expense. Our cash, you could say the credits have to equal the debit, so it has to be $1,030. Or you could say we are supposed to pay back the full balance of the liability, the note, $1,000, but we also have to pay back the $30 in interest. So we have to pay out cash of $1,030. Okay? So another common way we see notes come about is just like a normal loan. So instead of turning accounts payable into a note payable, we could just borrow money and recognize a note payable. It's like a small term loan. So let's say we have a new objective. Let's say we borrow $5,000 with 15% interest for 90 days. Okay. So here's the key word, we borrowed. So we're not turning an account payable into a note. We're just borrowing money. So in this case, we debit cash, $5,000, because we're receiving $5,000 as a loan. We're going to credit note payable, $5,000. So we're recognizing the liability we now have to pay in the future. So this is right when we borrow it. Okay. Debit cash, we're receiving cash, credit note payable. Now let's say it's 90 days later. What journal entry will we need here? Well, first of all, you got to debit note payable. All right, $5,000. We have to get this liability off the books. We're going to pay them back. So we're paying them back the balance we owe, $5,000. Next, we still have to debit interest. So it's the same way. The only thing that's changed in what we're doing here is that initially we recognize cash, where up here we just turned an account payable to a note payable. So we're going to debit interest expense, and I'm going to go ahead and make our formula. Again, it's the value, 5,000, times the interest, which is 15% in this case, times the number of days it's outstanding over, again, assume 360. So we're going to pay $187.50 in interest. And then we're going to credit cash. All right, and we're going to credit cash. We owe them the $5,000 principal amount on the loan, on the note, plus the interest, so $5,187.50. Okay, it doesn't get more complicated than this. We actually jumped the ship earlier, and we talked about notes receivable. We could have just waited to talk about notes receivable here and do a comparison, but we already talked about note receivable, so we're not going to talk about it again. Now, the next topic with note payable, the last real meaty topic of this chapter, is something called a discount note payable. And a discount note payable is basically you receive a note, you borrow money up front, but you actually recognize the interest immediately and you receive a discounted amount of cash. So I'm going to click over here. So discount notes are when borrowers receive less cash now and recognize interest immediately. Okay. So instead of receiving a full amount of cash, you receive less, you recognize interest immediately, and then when you have to pay the note, you pay back the full amount of cash. We're going to see that makes sense right now if that was a little confusing. So let's say we borrow a 90-day discount note totaling $20,000, and it has a 15% interest rate. Okay. So this is the key you got to look out for when you're doing homework or practice. Discount note. Discount note has different methods than a normal note. Nowhere here did we say discount, right? but here we're saying discount. So we borrow a 90-day discount note totaling $20,000 and it has 15% interest. First, what I'm going to do is I'm going to tell you how the journal entry is going to be set up. We're receiving cash. So again, we're saying we borrow this note. So we debit cash. The very day that we borrow the note, since it's a discount note, we're going to recognize interest expense. Okay, so this is the day we borrow it. Okay, notice the difference. When we first borrowed with a normal note, we did not debit interest. See that? So we debit interest expense right away, and we credit notes payable. Note payable. So this is the setup. Now, right away, the easiest thing you could do is you could fill in what you credit note payable for. Notes payable gets credited for the full value of the note, no matter what. So $20,000. Okay, this is the amount we have to definitely pay back when the time comes. It's the principal of the note. Now, with a discount note payable, the total value in this case is $20,000. But with discount notes, we do not receive that full amount. With a discount note, we receive the $20,000 less the interest that would accrue on this $20,000 over 90 days. Okay? So the best way to do that is to first calculate interest expense. So you calculate interest expense the same way you would every other way. You're going to debit $20,000. I'm sorry, you're going to multiply $20,000 by 15%, multiplied by the days the note's going to be outstanding, again, over 360, and our interest is going to be $750. Okay? So the cash we receive, again, nice little email about what I'm doing right now, moving classes online. When we debit cash, we're going to debit it for the full value of the loan, $20,000, less the interest. This is why it's a discount note. We are receiving a discounted amount of cash up front. Okay? So we are only receiving $19,250. We recognize interest expense immediately, and we credit note payable for the full amount. Now with a discount note, 90 days later, it's actually much simpler. So you're going to see when we're done that the discount notes are a little harder at first, but they're easy when it's time to pay them back, which is the inverse of a normal note payable. So 90 days later, when it's time for us to pay our debt, one, we have to get rid of this note payable. We're paying it off. It's a liability. We got to debit it, $20,000. So we're going to debit note payable, $20,000. There we go. Now, we already recognize interest expense on the day we took out this note. On the day we borrowed it, we recognize interest expense. So we're not going to do anything else with interest expense. Instead, we just have to credit cash for $20,000. So with a discount note, you receive less cash, but the maximum amount you have to pay back is the face value, the $20,000 of the note. That, notice, is different. With a note payable, you receive the full amount of cash, $5,000, but then you got to pay back more when it's time to pay. So if you see here, we borrowed $5,000 in cash, we received that full $5,000. Okay, that was the full value of the note. But when we had to pay it back, we had to pay back the $5,000 that we received plus interest. So it totaled more than the face value. With the discount note, we are receiving less upfront, less cash. We recognize interest immediately, but when we have to pay it all back, we only pay back the full amount of the note. So that's what a discount note is. Basically, if you don't want to have to pay more money in the future, this is a good way to go. Okay? So I'm going to end this one here. I said it'd be short and sweet. Again, we talked about notes receivable. I think this will be easier to comprehend. Notes, a discount note payable might slip you up compared to a note payable. Try the practice, watch this video, read through the PowerPoint, and ask questions. Okay? All right, quick one over and out. They'll probably be longer from here on out, but we'll see.